Good morning, dear students. Good morning. I welcome you all to this revisionary session of ICAI, wherein we are targeting revising the chapter of mutual funds with certain concepts being covered in the initial phase, and then later on we'll take up certain case studies to understand, to revise this topic of mutual funds. So, we already covered this subject, this topic extensively in our regular sessions, but it's better to revise the things before we go for the exams. So we are just around the exams. Exams are just around the corner, so we can just you know uh, work around with that. So now coming to mutual funds, let's just try to quickly recap the concepts of the mutual funds, and then we will take up the case studies. Okay. So now, when we look at a mutual fund, it's like uh, a combination of funds which is collected from multiple parties. So the mutual fund begins the story with the sponsor, right? So we've got a sponsor. So the mutual fund story starts with a sponsor. Okay. So this is the sponsor that we have. Now, the sponsor is going to approach, public at large. Sponsor is going to approach public at large. And let's say sponsor is going to put some amount, let's say 10 crores, right? It will approach the public at large to maybe contribute, let's say 990 crores. And this entire amount of 1000 crore, which will be handed over to a trust. And this trust is what we call as the mutual fund. Trust is going to hand over this money to someone called as a AMC, which is the asset management company. That AMC is going to put money into the portfolio. Okay, so that AMC is going to put money into the portfolio. So we have a sponsor, we have the public, and the trust, and that is going to be put into the AMC. You also have certain parties called as custodian, who's going to hold the securities, registrar and transfer agent, who is going to look into the transferring of the mutual funds from one party to another party. So this is the entire structure. Now, there are various types of mutual funds, but the most important term which is used commonly in mutual fund is something called as NAV calculation. Okay, so NAV is going to be simply total assets minus total liabilities divided by number of units. Total assets minus total liability divided by the number of units. So these assets is going to definitely include all your investments made by the mutual fund, all the cash holdings that the mutual fund is holding. So that's your total assets basically. From that, you subtract the total of liabilities, which are the outside payments, and then you divide by the number of units. And remember, these assets and liabilities are going to be valued at current market price. They're going to be valued at current market price. Okay, so NAV is total assets minus total liabilities upon number of units, which is going to be valued at current market price. Okay, that's your NAV, guys. Now, then we do have certain concepts called as entry load, which is the charges that as an investor you need to pay when you make an investment into the mutual fund. Exit load, these are the charges that you pay when you're going to take an exit or you're going to redeem your units, right? So we have the entry load, we have got the exit load. Okay, So NAV, when you are going to say entry load, it's always, and in fact, NAV, entry load and exit load both are going to be somewhat a percentage of your NAV itself. Okay. Now, these calculations, I mean, these entry load or exit load are definitely going to be dependent, are going to determine what's the rate of return as a mutual fund investor you are earning. Okay, so the rate of return is going to be dependent on your NAVs. It's also going to be dependent on the the dividend that is being paid out. Okay, right. So that's your NAV calculation, guys. Now, apart from this, we have certain performance measures that we have already covered in the portfolio management. Now, let us simply go ahead with the questions, which is relevant for our understanding and for revising this particular topic. So we have a wide variety of questions, especially targeting the calculation of NAV, calculation of returns for the mutual funds, right? So, let's just take up this case scenario. So we have got like, what, 3 case scenarios, right? And then we'll look at the security valuation part later on. So first, let us talk of mutual fund. Okay, case scenario number 1. So I'll just give you a minute's time. Look at the case scenario first, including the MCQ questions, and then we'll start with the solution or discussion about the same.
Jagbandhu ji, is there any issue?
एक सेकंड है सर, जस्ट अ मिनट. हाँ, आई थिंक कैमरा का इशू आ रहा था, अभी तो ठीक है. ठीक है, अच्छा, क्योंकि पता नहीं मुझे शायद ओके है ना. Okay, so Mr. Y has invested in 3 mutual funds as per the following details. So we have like 3 mutual funds, mutual fund X, Y, and Z. Net asset value at the time of purchase. So when the mutual fund was purchased, the NAV is given to us to be 10.3, 10.1, and 10. And then the amount of dividend received is provided as 9,000, 0, and 6,000. Now, mind it, this is the total amount of dividend that you have received. It's not the amount of dividend per unit. Now, the closing NAV is 10.35, 10, and 10.3. And then the effective yield is given to us, guys. Effective yield as on 31st March 2023 and this is per annum yield, and we are going to assume a year to be comprising of 365 days. Okay, so now obviously we would have probably made investment at different duration, and therefore you can see there is a number of days for which mutual fund XY is going to be held. So now we have like mutual fund X wherein you invested 4 lakh. At that time you had purchased it at an NAV of 10.3. Moreover, you have also got an NAV ending NAV of 10.35. Now effective yield per annum is 9.66, right? So I need to look at multiple parts. Now if you look at the MCQ questions, what they are really asking about, it says what's the total NAV of mutual fund Y as on 31st March 2023. So total NAV, obviously total NAV will be simply the closing NAV multiplied by number of units. So we need to get the number of units. Secondly, total yield of mutual fund X in terms of rupee. Now for mutual fund X, we need the yield in terms of rupee, right? So in terms of rupee would be, looking at again the profit that you have made over and above the investment. Then number of days for which mutual fund X and Y was held. Now let's just do one thing. We can definitely calculate these MCQs easily, but we'll try to solve this in a more comprehensive way for all the 3 mutual funds. Okay. So let's just continue and look at this particular case scenario in a comprehensive way. Now, we have got mutual fund X, mutual fund Y, and mutual fund Z. Okay. So what we have as numbers over here, so we've got the amount of investment that we are made in each of the years, right? So amount of investment is what? 4 lakh, right? 4 lakh, 8 lakh, and then 4 lakh. Then NAV at the time of purchase, NAV at the time of purchase is 10.3, 10.1, and 10. And then dividend that we have received. Okay, so dividend is what? 9,000 in case of mutual fund X, nothing in case of mutual fund Y, and 6,000 in case of mutual fund Z. Okay, so that's your dividend. And then we have NAV as on 31st March 2023, which is 10.35, 10, and 10.3. And then effective yield per annum. Effective annual yield is given to us to be 9.66 minus 11.66 and 24.15. Okay, now, so we're going to assume 1 year to be comprising of 365 days. What we have to compute is we'll just solve it in a holistic way. We'll calculate the total value at the end of the year. We'll also calculate the effective annual yield is given to us, but then we'll also calculate the number of days for which we are holding the mutual fund. Okay. Now, first up, we need to get the number of units, guys. Number of units purchased. What is the number of units that we would have purchased? Because see, at the time of purchase, the mutual fund was NAV was 10.3. And the amount of investment that we have made is 4 lakh. So amount of investment that we have made is 4 lakh. So we can get the number of mutual, and I mean the number of units simply by dividing the amount of investment by NAV at the time of purchase. Okay, so we divide the number of units by NAV at the time of purchase. So that's going to be how much? 4 lakh divided by 10.3. Yeah, so that's going to be 4 lakh divided by NAV at the time of purchase. It was 10.3. So the number of units is 38,834.95. Then for mutual fund Y, it's going to be 8 lakh divided by 10.1, which is 79,207.92. Then it is 4 lakh divided by 10. Oh, that's simply 40,000. That's the number of units that we have purchased. Now we can definitely get the value of investment or value of all units, as on 31st March 2023. So value of all units as on 31st March 2023, it's going to be 38,834.95 into 10.35, which is coming out to be 4 lakh 1,941. And then in the second case, it's going to be what? 77 lakh 92,207.92. And then the last one is going to be simply the number of units is 40,000 into 10.3, which is 4 lakh 12,000. Okay, so value of units is what we have got over here. Value of all units as on 31st March 2023. So value of units purchased is 38,834, and the value of units at the end is this one. Now the dividend is already known to us, and we would obviously like to look at the other part, which is how have we got the effective annual yield. Now we have been told the effective annual yield to be 9.66, but we want to know the number of days for which the investment was made. So number of days for which investment was made, how do we compute that? Pretty simple. See, how do we get the effective annual yield? The effective annual yield is basically value at the end minus value at the start plus dividend upon value at the start into 365 by the number of days. Right? So, of course, if I want to know the number of days, guys, that's going to be effective annual yield, right? So first we will calculate this particular portion, guys. This is the holding period return. We can definitely calculate this particular number of holding period return, guys, right? So once we have calculated the holding period return, now the effective annual yield is what? Simply holding period return into 365 by number of days, right? So you can say effective annual yield into, or effective annual yield divided by holding period return into 365 will be your number of days, or I can just say rearrange this as the number of days will be equal to holding period return into 365 by effective annual yield. Okay, so first part, let us calculate the holding period return. So the holding period return is going to be like in case of mutual fund X, holding period return. Yes, Swaminathan.
All right. Sir, that mutual fund Y on the NAV 31st, we calculated 792,207. It's 2079.
207. Oh, I think I spelled out to be 2079, but I wrote it as,
Yes, sir. Okay.
I think
Yeah.
2 extra over here. 7,92,079.2. Okay, so let's calculate the holding period return, guys. Holding period return is going to be, like in the first case, it's going to be 4,01,941 minus 4 lakh plus the dividend of 9,000 divided by 4 lakh. Okay, so give me the holding period return for the first mutual fund, which is mutual fund X. What is this number? 4,01,941 minus 4 lakh plus 9,000 divided by 4 lakh, which is 2.735. 2.7353%. Same way, calculate the holding period return for the mutual fund Y and mutual fund Z. Hmm? What's the holding period return for the second thing, which is going to be 7,92,079.2 minus the investment of 8 lakh. And there's no dividend. So this divided by 8 lakh. So this is going to be what? 0.99%, negative 0.99%, guys. So minus 0.99%. Then the second, mutual fund Z, it's going to be 4,12,000 minus 4,12,000 divided by 4 lakh, right? Sorry, it's going to be 4,12,000 minus 4 lakh plus you have a dividend of 6,000. So 18,000 upon 4 lakh into 100, that's 4.5%. 5% as the holding period return. Okay, so now we can definitely calculate the number of days by taking this simple formula into account. So it is going to be holding period return into 365 by effective annual yield. So number of days will be equal to holding period return into 365 by number of days. Sorry. So this is going to be holding period return into 365 by effective annual yield. So we have the holding period return as 2.7353. Right, this divided by effective annual yield is 9.66, and then into 365. So how much is this number? 2.7353 divided by 9.66 into 365. So that works out to be 103.35 or 103.35 days. Then in the second case, it's going to be minus 0.99 into 365 by effective annual yield, which is minus 11.66. 0.99 divided by 11.66 into 365. We have that as what? 31 days. And then last we have 4.5 divided by effective annual yield was 24.15. So that's 4.5 divided by 24.15 into 365, which is 68 days. So I've got the numbers for all of them. Right. So now if you look at the question, total NAV of mutual fund given above, total NAV of mutual fund Y as on 31st March 2023 would be approximately total NAV for mutual fund Y, guys. So what's the value of NAV for mutual fund Y? Of course, that's going to be option C over here, guys, right? So first answer is option C. Second answer, total yield of mutual fund X in terms of rupee would be approximately. Now, yield, when we are talking of in terms of rupee, you can see over here, total yield is going to be two things. One is the amount of dividend, and second is the over and above 4 lakh, the value is now 4 lakh 1,941. So 1,941, that's the value of all units that we have. So basically 1,941 plus this 9,000. So total is going to be 10,941, which is option A. Third, number of days for which mutual fund was held would be approximately 103.35. Number of days for which mutual fund Y was held, that's approximately 31 days. Yes, 31 days. So we were able to answer all of them, right? Okay. Fine. So that's the case scenario number 1. Let's look at the second case now, guys. So just a minute's time to quickly look at, just read the case scenario and then also the questions, because based on that, we'll do the calculations. Read this second case scenario, guys, along with the questions. Remember, just don't read the case in isolation. Look at what the questions are being asked, because then you'll be able to focus on which are the part of the case that we need to be, keen on. So, Mr. X, on 1st July 2021, during the initial offer of some mutual fund, invested in 10,000 units. Let me see if I can just open it. Okay, so while it just opens up, let's discuss it. So during the initial offer of some mutual fund, invested in 10,000 units having a face value of rupees 10 for each unit. Now for 31st March 2022, the dividend paid was 10%, and Mr. X found that at that time, his annual yield was 153.33%. Then on 31st December 2023, 20% dividend was again given. On 31st March 2024, Mr. X redeemed all his balance of 11,296.11 units when his annualized yield was 73.52%. And from the information given above, choose the correct answer for each of the questions. Okay. Let me just open it in our software so that we can access it easily. Okay. Here we have this. So on 1st July, during the IPO, initial offer, which is the NFO, 10,000 units having a face value of 10 was purchased. So of course, if you're looking at having a face value of 10, the total investment that we would have made is 1 lakh. On 1st March 2022, within a span of what? 1st July to 31st March, it's going to be what? 9 months. The dividend that was paid was 10%. At that time, mutual fund X was having an annualized yield of 153.33%. Then on Thursday, 31st December, 20% dividend was given. And on 31st March 21, Mr. X redeemed all his balance 11,296. Now you can see initially you had 10,000 units, but when you are redeeming, you are having 11,296.11 units. What does this indicate? What does this mean? What does it mean, guys? That of course, when the mutual fund has received units, it has received the units. Mutual fund has received the units against new dividend, against the dividend that was declared. Okay, so we have to remember that every time the dividend was paid to us, it was always a case of being units given to us instead of cash. We have been given dividend in the form of units. So let's just take that into account and try to do the calculations that we need. Now, what are the numbers that we're supposed to calculate? First, we need to know what's the NAV as on 31st March 2022. Second, what is the number of units on 31st March 2022 that will be taken into account? dividend as on 31st March 2023, and also NAV as on 31st March 2023, NAV as on 31st March 2024. So we need to calculate NAV at all times, also the amount of dividend. Okay, so let's just solve it again in a comprehensive, and then we can easily answer the question. Okay, so here we have this question in front of us. Now, during the initial offer of some 10,000 units was invested. So amount of initial investment is 10,000 units into face value of 10 each, which is 1 lakh. Then on 31st March 2022, the dividend paid by mutual fund was 10%, and Mr. X found that his annualized yield was 153.33%. So on 31st March 2022, dividend paid by mutual fund was 10%, guys. So dividend, or we can say the amount of dividend, so the amount of dividend is 10,000 units into face value of 10 into 10%, which is, of course, rupees 10,000 was the dividend paid, and it was found that his annualized yield at that time, it was 153.33%. Now, we don't know what's the NAV as on that time, but we can definitely say let the NAV on 31st March 2022 be rupees X. Now, if the NAV is rupees X, therefore, value of investment as on 31st March 2022, value of investment as on 31st March 2022, it is going to be like 10,000 X. Right, so 10,000 X. Now, of course, we would have got the annualized yield over here. Annualized yield is going to be what? Closing value, which is 10,000 X minus initial investment of 1 lakh plus the amount of dividend of 10,000. And then this is going to be divided by 1 lakh into 100 into 12 by 9, because it was for 9 months. Okay. Now this is supposed to be what? Annual yield is what? 153.33% as on 31st March 2022. So this is 153.33. Okay. So can we just solve this and get the value of X, guys? Can we just solve this and get the value of X? Solve this and get the value of X, guys. Solve this equation. Are we able to solve it? Yes, Swaminathan, Geeta. Can we solve this and get the value of x? Very simple equation, like a 10th standard normal problem. Get the value of x, guys, to get the NAV as on 31st March 2022. Yep. Okay, so I'll just say this as what? 10,000x minus 90,000 is equal to 153.33 into 9 into 1 lakh divided by 100 into 12. So this is what? 153.33 into 9 into 1 lakh divided by 1200. So this is what? 1,14,997.5. So 10,000x minus 90,000 is this figure. So we can say 10,000x is 1,14,997.5 plus 90,000 plus 90,000. So this is what? 2,04,997.5 is 10,000x. So the value of x is going to be 20.499, or we can say it is 20.5. So NAV is what? 20.5. So do we have a question over here? Yes. So the first question says, what's the NAV on 31st March 2022? That's going to be 20.5. Okay, now the second question is number of units as on 31st March 2022. So what will be the number of units as on 31st March 2022? So we need to first get the number of units which are given to us as dividend. Number of units allotted as dividend. Number of units which are allotted as dividend. The number of units which are allotted as dividend is simply going to be the amount, which is 10,000, and the units, we're having a NAB of 20.5 each. So the number of units will be 10,000 divided by 20.5, which is 487.80. So total number of units as on 31st March 2022. So as on 31st March 2022, originally you had 10,000 units plus 487.8 units. So that's going to be 10,000 plus 487.8. So which is 10,487.8 units. That's the number of units as on 31st March 2022. So 10,487.8. So that's option A. Right? Now, further, it says on 31st December, again 20% dividend was paid. Right? So on 31st December 2023, 20% dividend was paid. Now, of course, this dividend is going to be acting like a return for the investor, right? Okay. So we have that it's going to be an additional return. And when you say that 20% dividend was paid, now remember, as on 31st December 2023, the question is dividend as on 31st March 2023 and NAV as on 31st March 2023. Oh, sorry, I think there is a mistake. This should not be 31st December, this should be 31st March. Because on 31st March, we are getting a dividend of 20%. And even the question asks us what's the dividend on 31st March 2023. So as on 31st March 2023, 20% dividend was paid, but this is going to be obviously a percentage of your face value. But now the face value is not 10,000 units because you have got some additional units. So this is going to be the units multiplied by 10. That's the dividend we are going to have. So now let's do all our calculation on 31st March 2023. 31st March 2023. Okay. So as on 31st March 2023, we can say NAV, or we can say what is the amount of dividend. So dividend amount is going to be as on 31st March 2023. We want to know the dividend amount. So which is going to be, so as on 31st March 2023, we want the amount of dividend. So the amount of dividend is going to be, we have been told that it's a percentage in the question. The percentage of dividend is 20%. But then since it is 20%, it's going to be 20% of 10,487.8 into 10. Right, so that's going to be 10,487.8 into 10 into 20%. So the amount of dividend is 20,956. 20,975. 20,975.6 is the amount of dividend. So I think the question is asking us the same thing. So that's going to be option C, 20,975.6. Okay. Now, obviously, this amount is also being paid out in the form of units. So we want to know what's the NAV as on 31st March 2023. So now to get the NAV as on 31st March 2023, we have the dividend, which is 20,975.6. The amount of dividend is 20,975.6. Annualized yield is 73.52%. So on 31st March 2023, we want to look at the amount of dividend. Okay. Now, dividend amount of 20,975 will be given to us in the form of units. So we want to know what is the number of units. How do we get to know the number of units? So remember, units allotted as dividend. We can definitely say the units which are allotted as dividend. It's going to be what, 20,000? I mean, the closing number of units, it stands as what, 11,296. 11,296.11. 11,000 units which are allotted as dividend is 11,296.11 minus the units which we had, it is 10,487.8. Right, so 11,296.11 minus 10,487.8. So the difference is going to tell us 11,296.11 minus 10,487.8, which is 808.3. These are the units which are allotted to us So the next question is going. Okay, so the units is not given to us anyways. So 808.31 is the units which are allotted as dividend. But then if I want to calculate what's the number of what's the amount of NAV rather, guys, right? So if you want to see what's the amount of NAV as on 31st March 2023. So NAV as on 31st March 2023 is so this is what 11,296 is the units. So I want to calculate the NAV as on 31st March 2023, guys. NAV as on 31st March 2023. This will be the total amount of dividend, 20,975.6 is the amount of dividend that you have earned. And against which you have got 808.31 units. So we have 20,975.6 divided by 808.31. So basically the NAV at that time, it works out to be 25.95. So NAV per unit is 25.95 per unit. Okay. Did we get it, everyone? Did we get it, everyone? NAV as on 31st March 2023. Yes. Okay. Now the last part is to calculate I think the NAV as on 31st March 2024. So now as on 31st March 2024, we want to calculate the NAV. And for that, the question is given us that our annualized yield is 73.52. Now there is no dividend as on 31st March 2024, right, guys? As on 31st March 2024, no dividend has been specified. So there's no dividend involved in that. So now as on 31st March 2024, we want to, basically calculate the NAV. So we have the annualized yield number with us. Right, so annualized yield is simply going to be value of investment as on 31st March 2024 so value of investment as on 31st March 2024 minus value of investment minus rather we can say just 1 lakh divided by 1 lakh into of course 12, but we need to look at the number of months. What's the number of months that I should have in the denominator? What should be the number of months that we should have in the denominator? What is the number of months in the denominator is? Number of months. Because we started the investment on 1st July 2021. So from 1st July 2021 till 31st March 2024. What's the total number of months that we have? How much is the number of months? From 1st July 2021 till 31st of March, 31st of March 2024. From 1st July 2021 till 31st of March 2024. How many number of months? 33, right? So I need to divide it by 33. So value of investment, we don't know about that. Let's take it as Y minus 1 lakh upon 1 lakh into 12 by 33. And of course, we do the multiply by 100 is equal to, what's the annual yield as on that date? It's 73.52. Okay. So now just solve this and give me the value of Y, guys. Solve this equation and give me the value of Y. What's the value of Y? 3,02,180. Let's just verify this. So we have what? Y minus 1 lakh is equal to 73.52 into 1 lakh into 33 divided by 12 into 100. So Y minus 1 lakh is equal to, and of course this is 73.52 into 1 lakh into 33 divided by 1200. This is 2,02,180. So Y is going to be 3,02,180, right? And then we have to look at what's the NAV. NAV will be 3,02,180 divided by number of units that was sold is 11,296.11. So this is 302,180 divided by 11,296.11, which is 26.75. Okay, so that's 26.75 is the NAV. Did you get this? 26.75. Now, if you look at the question, in the MCQ, yeah, we have this 26.75 available with us. Did we get this? Okay. Then the third case scenario. I'll just give you a minute's time. Read the case and then also the questions, and then we'll start the discussion. Just read the case, guys. A minute's time to read the case and also the questions. Okay. Have you read it? The asset management company of the mutual fund has declared a dividend of 9.98% on the units under the reinvestment plan for the year ended 31st March 2021. The investors are issued additional units for a dividend at a rate of closing NAV for the year as per the conditions of the scheme. So the AMC of a mutual fund has declared a dividend of 9.98%. So it has declared a dividend of 9.98% on units under the dividend reinvestment scheme for 31st March 2021. Investors are issued some additional units for the dividend at the rate of closing NAV for the year as per the conditions of the scheme. The closing NAV was 24.95 as on 31st March 2021. An investor, Mr. X, who is having 20,800 units at the year end, has made an investment in units before the declaration of dividend at the rate of opening NAV plus an entry load of 0.04. So the closing NAV as on 31st March 2021 was 24.95. Investor who has like 20,800 units at the year end has made an investment in the units before the declaration of dividend. So 20,800 units were purchased before the declaration of dividend at the rate of opening NAV plus an entry load of 0.04. And they're saying that NAV has appreciated 25% during the year. Face value is, let's say, 10. And the question asks us to answer the MCQs as opening NAV of AMC shall be. So we want to know what's the opening NAV over here. Number of units purchased. Again, number of units that have been purchased, because who is having 20,800 units at the year end, right? So we want to know what's the number of units that you have purchased, right? Because we are saying that we have purchased the NAV. I mean, so purchase the units at some opening NAV, right? So we are having 20,800 units, but these 20,800 units are definitely, including the dividend units, right? Then original amount of investment needs to be calculated, and then which of the statements we have the three, a couple of theory questions based on this. Okay, so now let's try to answer this simply. 20,800 is the number of units, and it has put a year end. So Mr. X, who is having this 20,800, made an investment before the declaration of dividend. Now NAV has appreciated, they're saying 25% during the year. So if the units have the NAV has appreciated 25% during the year, and the closing NAV is 24.95, what is the opening NAV that we want to know? Right? So we'll say let opening NAV be rupees X. Therefore, what will be the closing NAV, guys? Closing NAV will be X plus 0.25X. Right? So closing NAV is going to be X plus 0.25X, which is nothing but 1.25X. So closing NAV is going to be 1.25X, guys. So closing NAV stands as 1.25X. And this is going to be, the closing NAV is 24.95. This is 24.95. So the value of X will be 24.95 divided by 1.25. So what is the value of X? 24.95 divided by 1.25, which is 19.96. So this is our opening NAV, guys, 19.96, option B. Now, what is the number of units that we would have purchased? Now, we want to know what's the number of units that we have purchased, because we already have the units with us to be 20,800. That's a closing number of closing units, right? So the amount of investment is also we want to calculate. Now the closing NAV is 19.96, and we know that there are 20,800 units, right? And the dividend, it has made a dividend declaration of 9.98%. 9.98%. So we need to know what is number of units that we have purchased, right? So we don't know what is the number of units that we have purchased. So I need to first calculate that. Closing number of units, we can simply have the equation as closing number of units is equal to opening number of units plus. So closing number of units is opening number of units plus the amount of dividend plus units issued as dividend, right? Units issued as dividend. So closing number of units, that is, I think, 20,800. Yes. So closing number of units is 20,800. Opening number of units is something that we don't know. So let me name it as Y. Plus the units that we would have been, that would have been issued as dividend. That's depending on your closing NAV, which is nothing but opening NAV. That's going to be opening number of units into face value of 10 divided by 19.96. So the closing number of units should be equal to what? 20,800 should be equal to the opening number of units which you have, because this is 20,800 is the closing number of units, plus the units which are issued as dividend. Now the units which are issued as dividend is opening number of units into 10, opening number of units into 10 divided by 19.76. Okay, so this is Y into 10 divided by 19.96. So opening number of units is Y plus units issued as dividend is Y into 10 divided by 19.96. Because the dividends were issued, it has declared a dividend of 9.98% on units. Sorry, units which are issued as dividend. I need to say further that it's y into 10. This is a face value into 9.98% is the amount of, it's a percentage of dividend which has been issued, given to us. So that's into 9.98%. So original number of units is y, plus the units which are issued as dividend is y into 10 into 9.98%. And then you divide it by 19.96, because that's the closing NAV that we have, right? And that's going to provide us with the value of y. So just solve this and give me the value of y, guys. Y, which will be the opening number of units or the units that we have purchased. Solve this equation and get me the value of y. Solve this equation, guys, and give me the value of y. Check what is the value of y. Normal simultaneous. It's no, sorry, not simultaneous. It's a normal linear equation. Are we able to solve it? Yeah. So, well, it's going to be what? 20,800 is equal to y plus 10 point, sorry, it's going to be 10 multiplied by 9.98% divided by 19.96 y plus 0.05y. So this is 1.05y is equal to 20,800, right? So we get the value of y is what? 20,800 divided by 1.05. So this is 19,800, 20,800 divided by 1.05. 19,809.52. So if you look at the options, no, it doesn't seem to be coming up with the answer option, sorry. Closing NAV is given 24.95. Opening, we got it. The opening number of units we need to calculate, guys. So I don't think we are having this as an option. 1 second. The closing number of units will be your opening number of units plus units which are allotted to us. So units which are allotted to us, this is it. 1 second. This is 20,000. 20,800. So 20,800, it will be 20,800. Number of units will be equal to y plus y into 0. It's 10 into 19.98 divided by, oh, yes. The units that will be allotted to us will be based on closing NAV, right, guys? So closing NAV was 24.95, yes. So this will be divided by 24.95. It's my bad. Because this is the amount of dividend, right? So the numerator part, this is the amount of dividend. Okay, this is the amount of dividend. And 24.95, this is the closing NAV. Right, so amount of dividend divided by closing NAV. So we can definitely get now 20,800 as the closing number of units, and that should be equal to this particular part. So this is going to be what? Y into 10. So it will be like 10 into 9.98% divided by 24.95. Yeah, so this is going to be 0.04y. So 20, this is going to be what? 1.04y is 20,800. So y will be 20,800 divided by 1.04. So y is what? 20,000 units. So that is option D, guys. Correct. Option D. So option D is correct. 20,000 units. Now, what is the amount of original investment? We want to know the original amount of investment. So original amount of investment will be original amount of investment. How do we get the original amount of investment, guys? Of course, the investment amount will include the NAV price, also the entry load. Now the question asks us that there is an entry load of 0.04 and our opening NAV is basically given to us. So opening NAV is 19.96. So it's going to be like opening NAV plus entry load, and this entire thing multiplied by units. So opening NAV, we got it as 19.96 plus we have also the entry load given to us. So the entry load is what? 0.04, guys. Entry load is 0.04 into the units is 20,000. So what is the original amount of investment? This is what? 20 into 20,000, which is 4 lakh. Right. So here the option original amount of investment is option A, which is 4 lakh. Okay. Then what will be the answer for fourth and fifth, guys? Can you give me the answer? These are theory questions. Fourth and fifth, we got the theory questions. Try to answer them. Try to answer the theory question. Fourth and fifth. So which of the following statement about expense ratio are incorrect, guys? Okay, expense ratio, it is a percentage of income that is spent to run a mutual fund. Is it a percentage of income? So it is a percentage of income? Or no, it's not a percentage of income as such. Is it a percentage of income that is spent to run a mutual fund? Okay, let's look at it includes advisory fees, travel costs, registrar fees, custodian fees. Yes, it includes. It includes brokerage cost for trading of portfolio. Yes, it does include. And then high expense ratio can seriously undermine the performance of mutual fund scheme. Yes. So this one is true. This one is true. This one is true. But it's not a percentage of income. It's a percentage of NAV. So which one is incorrect, guys? Only first one. It includes brokerage cost, right? It does include the brokerage cost, correct? Which of them is incorrect? Okay. So when you look at incorrect, it doesn't include advisory fees is included. Then high expense ratio that is also done. It includes brokerage cost for trading of portfolio. No, guys, brokerage cost is not included. This is false and this is false. So it's going to be option 1 and 3. I mean option B, right? Because when you say brokerage cost, that is a when you say brokerage cost, that's taken into the cost of investment. That's already taken into cost of security. So that's not your brokerage. That's not your expense ratio. Expense ratio is the expense that you incur, that the cost that you incur for the purpose of you're incurring the cost for the purpose of running of the mutual fund. Okay. Okay. Fifth one. Dash considers and uses downside deviation instead of total standard deviation. Which of these four, guys? Which of these four considers only the downside deviation? Which of these four considers the downside deviation is expense ratio, Sharpe ratio, Trenor, or Sortino? Only the downside is when we say it's Sortino ratio. Sortino ratio, perfect. So that's Sortino ratio. Okay. Now, so we've done 3 questions, 3 cases on mutual funds. Now, let us take up the next case, which is a case on the business valuation, guys. So we'll take up the case on business valuation. Now, this business valuation case is what we are going to cover over here. And then after that, we'll discuss some questions from the MTP. Now, let's look at this case scenario 4. During one business meet, at XYZ Limited, one of the member pointed out that while evaluating the performance of any company, one should not only see its operating income, but it should also analyze its capital structure as well. Weighted average cost of capital changes on the basis of capital structure, keeping all other factors unchanged. So during one of the meetings, one of the member pointed out that while evaluating the performance of any company, one should not only see its operating income, but also analyze its capital structure as well. And weighted average cost of capital changes on the basis of the capital structure, keeping all other factors unchanged. He presented the data relating to three companies, Alpha, Beta, and Gamma, whose operating income are equal, but their capital structure is different. So we have Alpha, Beta, Gamma, all three companies. We have the total invested capital available, total invested capital, debt to assets ratio, right? Shares which are outstanding, pre-tax cost of debt is given to us. Cost of equity 26, 22, and 20%. EBIT is given to us, and all three companies are having the same EBIT. Now the tax rate is 35%, which is uniform. Industry P ratio is 11x. Right, so industry P ratio is 11x. Now from the following information, choose the correct answer to the following questions. Now you have to choose the correct answer. Now the correct answer, we have to look for 5 questions. So if you look at the questions that are being asked, first we need to calculate the weighted average cost of capital of alpha. Then we have to calculate the EVA of beta. Then we have to get the price per share of gamma, estimated market capitalization of alpha, earnings per share of beta. Okay, so we'll try to calculate, we'll try to solve this question in a comprehensive way again, wherein we are going to look at the holistic picture. We'll try to calculate everything for all the three companies together. So let me just write down this data. Okay, so this is the data that we have. Now, what we are supposed to calculate, what all things are we supposed to calculate? We have to get the weighted average cost, WACC, EVA, price, because we have the P ratio, market capitalization, and earnings per share. Okay, so what all things we need to calculate? I'm just jotting it down. Weighted average cost of capital. Secondly, we need the EVA. We need the EVA. We need the market price per share. We need the earnings per share. Market price per share, earnings per share, and then market cap. Okay, so these are the items that we need from each of these quantities. So first, when you want to calculate the weighted average cost of capital, we have the cost of equity, we have the cost of debt. Of course, we need to make it as a post-tax cost of debt. And then we have debt to assets ratio. Total invested capital is 20 lakh. Debt to assets ratio is given to us. So total capital invested is same. So debt to assets ratio is 0.8. So of course, we can get the weightage of equity and weightage of debt. So first we need to get the KD, which is post-tax. So we'll just take, say, post-tax cost of debt. It will be, of course, the pre-tax cost of debt is pre-tax cost of debt into 1 minus tax rate. And what's the tax rate given to us in the question, guys? Tax rate is 35%, right? So 1 minus 0.3. So we can get the post-tax KD. We have the weightage of debt to be 0.8. In fact, we can just say that this debt asset ratio is nothing but weightage of debt. And we can get the weightage of equity. Weightage of equity will be 0.2, 0.5, and 0.8. And then we can calculate the weighted average cost of capital to be equal to weight of equity into cost of equity plus weight of debt into cost of debt. Weight of equity into cost of equity plus weight of debt into cost of debt. Okay, so just calculate the WACC over here, guys. Give me the weighted average cost of capital. Calculate the post-tax cost of debt and then the weighted average cost of capital. Give me these numbers, guys. Are we calculating the WACC? So first you give me what is the post-tax cost of debt. Post-tax cost of debt, guys. Yeah, amounts of post-tax cost of debt, guys. Well, यहाँ पे the post-tax pre-tax it is 16. So that's going to be what? 16 into 1 minus 0.35. So that amounts to 16 into 0.65, which is 10.4%. Then next it is going to be 13 into 1 minus 0.35, which is 13 into 0.65, which is 8.45%. 15 into 1 minus 0.35, 15 into 0.65, which is 9.75%. So now the weighted average cost of capital is going to be 0.2 into cost of equity of 26 plus 0.8 into cost of debt of 10.4. Then 0.5 into 26 plus 0.5 into 8.45. Then the third one, it is 0.8 into 20 plus 0.2 into 9.75. Debt in second case is 10 lakh. 10 lakh, sorry. Debt in second place, thirdly. Yeah, that is okay, but we're talking of weightage, right? So weighted average is 0.2 into 26, right? Because debt to asset ratio is 0.8. So this is the weightage of debt. So weightage of equity is 0.2. So 0.2 into 26% plus 0.8 into 10.4. Right? Geeta? So what's the weighted average cost of capital then for the first company? 0.2 into 26, which is 5.2. 0.8 into 10.4, which is 13 point in post debt. No, we have the pre-tax cost of debt, right? So pre-tax cost of debt is multiplied by 1 minus tax rate. So I'm not getting what you're saying. So that is a post-tax cost of debt, right? Okay, so this is 13.52. That's WACC. Then for the second company, it is 0.5 into 22. It is 11. And then 8.45 into 2.5. So which is 15.23. And then you have 20 into 0.8 and then 9.75 into 0.2 plus 16, which is 17.95. Let's look at the first question. I think the weighted average cost of capital of Alpha, first company, which is 13.52, that has been answered by us. So post-tax cost of debt is done. Then we have to calculate the EVA. Now, economic value added. It is net operating profit after tax minus WACC into total capital employed. Now, NOPAT is nothing but earnings before interest and tax into 1 minus tax rate. Earnings before interest and tax into 1 minus tax rate. And this minus weighted average cost of capital, which is what we have already got, into total capital employed, that is anyways 20 lakh. Right? So that's going to be WACC minus 20. So we've got the EBIT numbers also for all of them. So EBIT is what? 5 lakh. So this is going to be 5 lakh into 1 minus tax rate. Now the tax rate is what? 35%. So 5 lakh into 1 minus 0.35. So EBIT into 1 minus 0.35 minus WACC into total capital employed. So WACC is 0.1352, or this is going to be 13.52% into this is WACC multiplied by 20 multiplied by 20 lakhs. So what's the EVA? 5 lakh into 0.65, which is 3,25,000. So we have 3,25,000 minus 20 lakh into 13.52%, which is 2,70,400. So 3,25,000. 3,25,000 minus 2,70,400, which is 54,600. Right? Same way, for the second one, it's going to be 5 lakh into 0.65 minus 15.23% into 20 lakhs. So 5 lakh into 0.65, that is 3.25 lakhs minus 20 into 15.23%, which is 3.046. So this is 3,25,000 minus 3,04,600, which is 20,400. So is that the option available? 20,500 approximately, I think. Yeah. So 20,000. Okay, we can just make it as maybe a rounding up figure, 3.05. So I think that was, our WACC was something different. So 0.5 into 22, which was 11, 0.5 into 8.45 plus 11. Yeah, 1 second. 8.45 into 0.5. Right? So 4.225 plus 11. It was 15.225. Yes, I just took it as 2 decimal. So if I just make it on those lines as the WACC, so our WACC is going to be 15.225%. And then when we do the calculation, this is 3.25 lakhs minus 20 lakh into 15.225%. Yeah, so that's 3.045. So 3,25,000 minus 3,04,500, which is 20,500. Yes. So economic value added is 20,500. What is the EVA for the third case, guys? Let's calculate the EVA for the third case. Calculate the EVA on the similar line for the third case, guys. What is the EVA? Then it's going to be same 5 lakh into 0.65 minus 20 lakh into 17.95%. So 5 lakh into 0.65, which is 3,25,000. 3.25 lakhs minus 20 lakhs into 17.95%, which is 3.59. So, of course, we have a negative EV over here, 3.25 minus 3.59, which is 34, negative 34,000. Okay, so EV is done. Next, what we want is EPS and MPS. Now, of course, for EPS and MPS, I need to get the PAT. Now, PAT will be obviously EBIT minus the interest minus the tax. So for that purpose, I need to also get the amount of debt also, which is basically value of debt. So I'll get the value of debt. In case of first company Alpha, the value of debt is going to be 20 lakh into 80%, right? So which is 16 lakhs. In case of second company, it's going to be 20 lakh into 50%, which is 10 lakh. In case of third company, it is 20 lakh into 20%. This is 4 lakh. Okay. So once you've got the value of debt, now we can start with interest amount. Interest will be before tax cost of debt into value of debt. So before tax cost of debt is given as 16%, 13%, and 15%. So that's going to be 16% of 16 lakh, 13% of 10 lakh, and 15% of 4 lakh. So we have 16 lakhs into 16%, which is 2,56,000. Then we have 10 lakh into 13%, which is 1,30,000. Then 4 lakh into 15%, which is 60,000. Now we can definitely start with the EBIT numbers. We have EBIT less interest, which gives us PBT, less tax, which gives us PAT. And then we divide this by number of shares so that we get EPS. And then you multiply it with P ratio to arrive at MPS. So we have the EBIT numbers. EBIT is what, 5 lakh in all three companies, right? Interest is what we have computed just now, 2,56,000 or 1,30,000 or 60,000. And then we have the PBT as 5 lakh minus 2,56,000, which is 2,44,000. 5 lakh minus 1,30,000, which is 3,70,000. And 5 lakh minus 60,000, which is 4,40,000. Okay. So we have got the tax rates also 35%. So just calculate the tax, then you'll get the profit after tax divided by number of shares. So number of shares is obviously given 61,000, 83,000, and 1 lakh. 61,000, 83,000, and 1 lakh. Okay. So just and the P ratio that we have to use is, that's given in the question, industry P is 11x. Okay. So can we just solve this? All the three numbers. Just subtract the tax, arrive at PAT, divided by the number of shares, which will give you EPS and then the PE number. Okay. This is tax 85,400. Okay. 3,70,000 into 35%. So that's 1,29,500. 4,40,000 into 35%, which is 1,54,000. Then the PAT numbers will be 2,44,000 minus 85,400, which is 1,58,600. 3,70,000 minus 1,29,500. 2,40,500. 4,40,000 minus 1,54,000, which is 2,86,000. And then we divide it by the number of shares. So it's 158,600 divided by 61,000. This EPS is 2.6. Second EPS is 2,40,500 divided by 83,000. That's 2.89 or 2.9 we can say. Then 2,86,000 divided by 1 lakh, which is 2.86. We can get the market price as simply multiplying them. 2.6 into 11. So market price is 28.6. That is 2.9 into 11, which is 31.9, and 2.86 into 11, which is 31.46. That's your market price per share. EPS is 2.6, P ratio 11, market price is 28.6. So we have got the market price per share. Yeah, EPS and MPS. Now the question is, what's the price per share of Gamma Limited? So price per share of Gamma is what? 31.46. 31.46. Market cap. And we can also answer this one. Earnings of Beta. Earnings of Beta, which is the second company, that's 2.9, right? And then market cap. Market cap is ultimately the market price per share into number of shares. So market cap is MPS into number of shares. So it is nothing but 28.6 into number of shares is 61,000. 17,44,600. Second case, it is 31.9 into number of shares is 83,000, which is 26,47,700. Then 31.46 into 1 lakh. 31,46,000. So estimated market capitalization of Alpha, which is 17,44,600, which is option C, guys. Okay. So with that, we're done with this case studies. With this caselets, all the 4 cases are done. Now let us take a break. Okay, and after break, we'll do certain questions on the MTPs. Okay, guys. Let's take a break, guys. Okay, let us continue. Yeah. Now let us take few questions from the MTP. So let's take a question of business valuation here, because we have done quite a good questions on mutual funds. So let's take a question on business valuation from the model test paper. Let us see. This is on page what 101. Okay. Let's open it there. So business valuation. We'll take a couple of questions maybe with the remaining time. Mutual funds, we have done 3 case studies. So let's give justice to the business valuation, which is page 101. Hmm. Okay, let's take up this question, which is a popular question that we have. Okay, question 4A is. So the valuation of a company named as Ansel Limited has been done by an investment analyst, and based on the expected numbers, so the valuation of Ansel Limited has been done by an investment analyst based on expected free cash flows of 54 lakhs for the following year and an expected growth rate of 9%. So expected growth rate of 9%, and we have an expected cash flow of 54 lakh. The analyst has estimated the value of Ansel Limited to be 1800 lakhs. However, he committed a mistake of using book values of debt and equity. Now, there's a mistake committed by the analyst. He has taken the book values. The book value weights employed by the analyst are basically not known, but you know that Ansel Limited has a cost of equity of 20% and a post-tax cost of debt to be 10%. The value of equity is thrice its book value, whereas the market value of its debt is 9/10 of its book value. What's the correct value of the Ansel Limited? So we have the valuation of this company based on a free cash flow of 54 lakh, and we have been arrived at a value of 1800 lakhs. But the mistake that was committed is they have used the book value of debt. Okay, so now the company has been valued. This is basically value of the business. Right, so we have been given the value of the business. Value of business is 1800. But we know this 1800 would have been arrived at free cash flow upon a free cash flow for the first year upon KO minus the growth rate. So we have 1800 is equal to free cash flow for the first year, which is 54 divided by free cash flow for the first year, 54 divided by KO, is something, that's not known to us, but we know the growth rate to be, 9% or minus 0.09. Okay, now, of course, from this we can calculate the value of KO. So can I just give you the value of KO, guys, from this? Solve this equation, give me the value of KO, overall cost of capital. Give me the value of overall cost of capital, KO, guys. What's the value of KO, guys? 12%. Okay. Well, we can do it simply as KO minus 0.09 is 54 upon 1800. So 54 upon 1800, 54 divided by 1800 is what? 3%, 0.03. So KO will be 0.12 or 12%. Okay. So KO is going to be 12%. So what do you say about this KO? Is this KO correct? No, because this KO is based on book value based. This is book value based KO. Now, but we want to calculate the market value based KO, because based on that we will do the calculation of the value of the business. Now they say that the value of equity is thrice its book value. Now, of course, we don't know what is the book value and what is the market value, but definitely we can say that the value of equity is thrice its book value, whereas market value of debt is 9/10 its book value. So we know that KO is calculated as the overall cost of capital is calculated as weight of equity into cost of equity plus weight of debt into cost of debt. Now, since this is what, 12%, this is 12, weight of equity is that we don't know. Weight of equity into the cost of equity is given to us to be 20%. Whereas weight of debt, we can write it as 1 minus weight of equity into 10. Weight of equity into K, which is 20, and 1 minus weight of equity into 10. So this is 12 equal to 20 weight of equity plus 10 minus 10 weight of equity. Okay. So this is going to be 12 equal to 10 weight of equity plus 10. So 2 is equal to 10 into weight of equity. And we have the weight of equity as what? 2 upon 10, which is 0.2. And this implies that weight of debt is 1 minus 0.2, which is 0.8. Right? So we get the weight of equity and debt to be 0.2 and 0.8. Now, these are book value based. Now, what will be the market value based, or let us say, let total value, or we can say let total book value be rupees 100. So we have equity, we have debt, and then we talk of the value. Equity value is 20. This is going to be 80, which is the book value. Now, what will we say about the market value? What will be the case of market value? Because they say that the market value of equity is thrice its book value, whereas the market value of debt is 9/10. So it's thrice. So market value is going to be 60. And this is going to be what? 9/10, which is 72. So which is 60 plus 72, which is 132. So market value is 132. So 60 plus 72, that's going to be 132 market value, which is 60 plus 72. Now, once we have got these weights, market value, we can definitely say what are the weights now? Market value weights. So it's going to be 60 divided by 132, which is 0.4545, and this is 72 divided by 132, which is 0.5455. These are the weights. Now, based on these weights, we can get KO based on market value weights. So KO based on market value weights will be 0.4545 into 20 plus 0.5455 into 10. So what's the KO using market value weights, guys? What is the KO using the market value weights? Overall cost of capital using market value weights. Yeah, calculate and tell me. What is the overall cost of capital based on market value? How much is the KO based on market value? This is 15.55%. So this is what 0.4545 into 20 plus 5.455. Yeah, 15.55%. Yeah, that's your Q. Overall cost of capital based on market value weights is 15.55%. 15 or sorry, 14.55, my bad. So 14.55%. That's our KO based on market value weights. Now, what will be the KO based on market value weights? Therefore, we'll say value of business. Now it's going to be free cash flow for year one upon KO minus. Now free cash flow for year one, it was obviously 54 upon 0.1455 minus growth rate of 9%. So 54, 14.55 minus 9, which is 5.55. So 54 divided by 0. Sorry, divided by 0.055. That is what? 972. 0.1455 minus 0.09. It's 0.0555. 254. Yeah, 972.97. That's the value of the business. Okay. That's this question number one. Let's do another question based on business valuation or mutual fund, whichever we can get. Whichever I see a good question, I'll take that up. Okay, let's look at this question. Question number 4A. So Eagle Limited reported a profit of 77 lakhs after 30% tax for the financial year 2011-12. An analysis of the accounts revealed that the income included extraordinary items of rupees 8 lakhs and an extraordinary loss of 10 lakhs. So in this profit of 77 lakhs, which is after tax figure, so it revealed that we are having an extraordinary item of 8 lakhs and extraordinary loss of 10 lakh. Existing operations, except for the extraordinary items, are expected to continue in the future. In addition, the results of a launch of a new product are also given over here. So details of launch of new product are given, which is going to provide us sales, material cost, labor, and fixed cost. And we have been given that the cap rate, which is the capitalization rate, is already provided to us. So capitalization rate is 14%, and we have to value this particular business. So capitalization rate is 14%. We need to capitalize, we need to calculate the value of the business at the capitalization of 14%. So of course, I need to look at what is the future maintainable profit and then simply capitalize it. Okay, just try to solve it, guys. Try to solve it. Okay, so first we'll have to calculate the future maintainable ordinary profits. Future maintainable ordinary profits, which is, we have a 77 lakh as a after tax figure. So we have a profit after tax of 77 lakhs. Of course, I want to make it a profit before tax. So which is going to be 77 divided by 30%. Sorry, 1 minus 0.3. So this should be working out to be what? 77 divided by 0.7, which is 110 lakhs. Profit before tax is going to be 77 divided by 0.7, which is 110 lakhs. Now, profit before tax is coming out to be this 110 lakhs, guys, PBT. Now, with this PBT of 110 lakhs, so PAT is 77 lakhs, PBT is 77 divided by 0.7, which is 110 lakhs. We need to remove the effect of extraordinary income and extraordinary losses. So, extraordinary income will be subtracted and we will add extraordinary losses. What is extraordinary income? Extraordinary income is 8 lakhs, which will be subtracted, and extraordinary loss is 10 lakhs, which will be added. And then just take a total of it. So this is going to be what? 110 minus 8 plus 10, which is 112 lakhs. Right? This is the future maintainable profit before tax. To that, we will add profit before tax from new project. So what will be the profit before tax from the new project, guys? PBT from the new project. What will be the PBT from new project? What will be the PBT from new project? PBT from new project? 70 minus, so this is going to be what? 70 minus 20 minus 12 minus 10. So total it is 70 minus 12 minus 10. 70 minus 20 minus 12, sorry. Minus 20 also. Which is 28 lakhs. So you can say over here, total future maintainable profit before tax. So you can just add them. 112 plus 28, which is 140. 140 lakhs. Now, value of business will be future maintainable profit before tax divided by KO, which is 140 divided by 14%, which is nothing but simple 1000 lakhs. Okay, so that's the business valuation. Simple method. Now let's look at some other questions wherein we can see, suppose now let's looking at, let's say, mutual fund or maybe the business valuation. Um, Okay, look at this question. So, Tender Limited has earned a net profit of 15 lakhs after tax at the rate of 30%. Okay, so we have a net profit of 15 lakhs, which is basically your PAT. This is your profit after tax. Interest cost charged by financial institution was 10 lakhs. The invested capital is total 95 lakhs, of which 55% is debt. And the company maintains a weighted average cost of capital of 13%. You have to first compute the operating income, then economic value added computation, and then 6 lakh equity shares are outstanding. So how much dividend can be paid, before the value of the entity starts declining? So first we need to compute the operating income. So we've got the profit after tax. We've got a profit after tax of 15 lakh. We want to compute the EBIT. We just need to add tax to this so that we get the PBT. Then we will add interest to this so that we get a EBIT, or the operating income. Calculate the EBIT and give me the number, guys. What's the EBIT? Calculate the value of EBIT. Let's do the reverse calculation. You got the EBIT? Okay, so tax is going to be like computed as what? 15 lakhs. This 15 lakhs divided by, of course, this represents 70. So into 30, because 30% is tax. So PAT is obviously the remaining 70%. Okay. So it's going to be 15 lakhs divided by 70 into 30. So tax will be, no, at 30% tax, right? So how did you get 29 lakh 50,000, Geeta? So the tax rate is 6 lakh 42 857, and this is going to be like 15 lakh plus 6 lakh 42 857, 21 lakh 42 857, and then the interest amount needs to be computed. Invested capital is 95 lakh. On this 95 lakh, 55% is debt, on which you're paying a interest of 13%. So 95 lakh into 55% into 13%. So this is 6 lakh 79,250. So EBIT is what? 21 lakh 42 857 plus 6 lakh 75 250. So it should be 28 lakh 18,107. Can you just verify whether this is what you're getting? Are you getting the same numbers, 28 lakh 18,107 as the EBIT? Just check this. Saminathan, Gopika, Geeta, just check. Are you getting the same number? 28,18,107. Are we getting this number, everyone? 28,18,107. EBIT number, correct? So you take 15 lakh, which is the PAT. Then if I divide it by 0.7 directly, also I get this PBT. On that, you add the 675,250, which is EBIT. So that's your operating income. 331 lakh. Is it 31 lakh 42,857? Sorry, I don't think so. 95 lakh is the total value, of which 55% is this. And on this, you're paying, sorry, weighted average cost of capital. No, there is some issue. The invested capital is 95 lakh, of which 55% is debt. Net profit of 15 lakh after tax. Interest cost. Oh, my bad. I missed out on that one because interest cost is already given as 10 lakhs. Correct. Interest cost is 10 lakhs. So this will be 31 lakh 42,857. This is our EBIT. I want to compute the EVA, which is economic value added. So EVA is net operating profit after tax minus weighted average cost of capital into total capital employed. So net operating profit after tax is nothing but EBIT into 1 minus T. EBIT into 1 minus T minus weighted average cost of capital into total capital employed. So EBIT is 31 lakh 42,857 minus weighted average cost of capital. That is given to us to be 13%. So it's going to be 13% of 95 lakhs. Okay. So this gives us what? 31 lakh 42,857. Sorry. 95 lakh into 13%, which is 12 lakh 35,000 minus 31 lakh 42,857. So this is 19 lakh 7,857. That's your EVA. That's your economic value added by the company. This is the extra value which the company has generated. Right? So this is the additional value generated by company. Now it has two choices. 19 lakh 7,857. Or rather, I can say this is something the value which has been generated. Now, if the company pays a dividend, if we can say if company doesn't pay dividend, value of company will increase by 19 lakh 7,857. Right? So this is going to increase by 19 lakh 7,857. But then it says Tender Limited is having 6 lakh equity shares outstanding. How much dividend can the company pay before the value of entity starts declining? So how much can the company pay before the value of entity starts declining? So we can say value of entity declines, value of entity declines if dividend exceeds the economic value added generated. Right? So max dividend that can be paid, maximum dividend that can be paid without reducing the existing value, that is the same as EVA, same as the economic value added which is generated. So the economic value added was 19,07,857. So this is the max dividend that you can pay. Okay. One second, what did I do? 31,40,000 into, oh, I didn't do it 70%. Okay, my bad. So this into 70%, correct. So this is going to be something, you know, I need to compute. Yeah, so 31,42,857 into 70%, guys. So 22 lakh, yes. 22 lakh is what the thing is. To 22 lakh minus 13% of that, which is 95 lakh. Minus 22 lakhs, which is 9,65,000. So 9,65,000. Which is 9,65,000. So max dividend which you can pay is the economic value added. So that is 95 lakh into 13%, which is 12,35,000 minus 22 lakhs. 9,65,000 is the max dividend that you can pay. And what is the dividend per share then? 9,65,000 divided by the number of shares which we have is 6 lakh equity shares. So you divide it by 6 lakh. So 9,65,000 divided by 6 lakh. 1.61. That's the maximum, dividend which you can pay without any reduction in the value. Okay, so dividend per share is 9,65,000 divided by 6 lakh, which is 1,65,000. Actually, 1.61 per share. Got it? Okay, so yeah, the dividend, maximum dividend which you can pay is 1.61, which cannot exceed the EVA which we have generated. Okay, so with that, I think we are towards the end of our today's session. We have done 4 case studies and 3 practice questions. Okay. So we have been providing justice to revising both the concepts, which is mutual funds as well as the business valuation. Okay. If you have any queries, we can take it up right now. Any queries, guys?
Okay, I think student does not have right now any query. Student, thank you very much for attending the same session and making it more interactive. And thank you, Jagbandhu sir, for sparing your precious time and enlightening the student in both this topic, mutual fund and business valuation, as they are very important topics. So student, even if actually after the class you have query, you can contact us at telephone number. Jagbandhu sir, just share my telephone number 0120 3045 956. And our contact email ID is sfm-final@ICAI.in. Okay, student. And okay, Jagbandu sir, then just write it again. Yeah. Thank you very much and have a nice day. Thank you.
Thank you. Thank you, everyone.
1 second, 1 second. Okay. I think student have logged out. Just a second. Have a wait some. Okay, it's over now.
Okay.
Thank you. Oh. Patience रखा करे